Hi, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion of what is happening in the economy, the world of finance, and personal investment with Art Jarvis. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Now here is Taking Stock. Welcome, Art Jarvis, to Taking Stock, episode number 47.
Chuck, how are you?
I'm well.
Good, glad to hear it.
All things considered.
Good.
How about you?
As always, I'm fantastic.
No, it's all good, man. All good. I'm, watching the market fly all over the place.
Yeah.
But it's April Fool's Day.
Yeah.
We're not going to play any pranks on the listeners.
I'm not going to mess with that.
We're going to. It's going to be straight. It's going to be straight talk, taking stock. But the fact that it's April Fool's Day, and we are here in Cincinnati as we record this on Tuesday, April the 1st. We're 4 games into the Major League Baseball season.
Yes, we are.
So when you ask how I am, I'm a baseball guy.
Yes, sir.
So, and after a big Reds win last night, Chuck's happy.
Yeah, what, 2-2, right?
They're 500 right now.
There you go. All right.
I'd like to see them get above that and stay above that and have a really good season. I'm looking for, if we, I hold you to the fire on your stock predictions, your money market predictions, your whatever, all the predictions that we make, economic and all that forecast in January. Okay, so baseball season's underway. Mm-hmm. I've been telling everybody on opening day and on the kids' opening day on Saturday, I was out there with a lot of people and said, this is the first day of the 2025 Cincinnati Reds championship season.
There you go.
So if you want to hold my feet to the fire when October rolls in, you'll have your chance. Chuck's prediction is it is a championship season for the Cincinnati Reds, and Ellie Dela Cruz is going to have a great year.
And knock on wood.
Yeah, well,
you're right. I hear him. Yeah.
We'll see. He's just working really hard. And so anyway, that's enough of that. We're taking stock of baseball for a minute there, but let's just jump right in to the economic world. And where are we?
Well, the smart aleck in me would say, we'll take this 30-minute podcast and turn it into a 30-second podcast and just say, we can just take the podcast number 46 and just replace it into 47 and we'll just leave it there because it hasn't changed a lot, to be honest with you. We have bounced around all over the place, going back to that whole buckle up comment at the beginning of the year. But yeah, we bounced around a lot, but we are almost, from an S&P 500 standpoint, we're almost exactly the same spot we were at 2 weeks ago today.
Well, and offline, you and I chatted about that a little bit. We were in January, right close to 6,200 on the S&P.
We actually hit 6,200.
6,200. Yeah. And as we chatted before, offline around 5,600 at close yesterday, which you said is 14 days later. 5,600, regardless of the ups and the downs over the last 14 days. But, Jarvis Global, as you say, you do everything internally.
Correct.
You're not like, let's watch TV and let's listen to what the analysts say and then follow that.
Yeah, it'll make you nuts. Let's put it that way. Yeah.
But a little bit, what are you hearing in the fall? What would you say about anything that analysts are saying? I mean, they're focusing again still. And I don't want to go back. We don't want to get focused on recession again, and we're not in one.
Right.
But they're still talking about the tariffs as they're continuing to roll out, so to speak.
But from an analyst standpoint, though, we are not. So I want to look at economic numbers, but I want to look at the corporate earnings numbers. What are the corporate earnings projections doing or look like 6 months, 12 months, 18 months from now? Well, guess what? They're not dropping. Okay, so we're still getting good corporate earnings numbers. Interest rates, let's say 6 months ago we were at, let's say, 4.5% on the 10-year Treasury. Today we're at about 4.2 or 4.25. So nothing substantial there, but that is lower interest rates, which is a positive for the economy and for the stock market going forward. We're not seeing some great big jump up in interest rates or anything like that. So, if I'm trying to do my analysis on certain sectors or the U.S. economy or some part of the global economy, the earnings numbers that I'm looking at have not changed, and the valuations that I'm coming up with have not changed drastically, in spite of all the rhetoric we have and things like that. And Chuck, I guess if I'm going to pound the table, and I think the most aggravating thing to me is the way things are portrayed on a daily basis in the news. And
Right.
I think I made mention of this maybe in the last episode. But, the market's down 0.1%, and the commentary is, the market has dove this morning, or the market declined, which, dove is not a right word, but declined, that's a correct word. But down 0.1% is down slightly, right?
Sure.
But the problem is then you flip the coin and the market's up 0.5% or 1%, and you get a comment, some kind of lukewarm kind of comment about the market being, and then they say, well, the market has risen or something like that. It doesn't say jumped or anything
Right.
like that. So, and then, another great example is, we got the Fed's favorite inflation number, the PCE, Personal Consumption Expenditure Inflation Indicator. But that number came out, and it was slightly higher than expected. I think they were looking for 0.26, and they came in at 0.28. So that number was higher. Well, the news story is okay, here inflation is coming back and blah 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 blah. No, it's not. Because just last month we had a better than expected.
Right.
But they're not that good, and they've made that clear. You look at things from an inflation standpoint, from an employment standpoint, they're not going to nail that number. And then the other thing they talked about was, they had been mentioning, and I'm going to bring up the recession thing real quick.
Ouch.
But they talked about, they were saying, the Atlanta Fed was saying they believe that the first quarter might be down 0.1%. So they believe that we're already in a recession, which, number one, by definition, we're not. Okay.
Right.
Number two, 0.1, I care, but I don't care a whole lot. But the other thing, now they just came out and they're talking about maybe the first quarter was actually up 0.3%. So our economy actually expanded, not by some great deal, but still up.
A growing economy, even if it's only 0.3%,
Right.
is growth, not recession.
Correct. It's not even the beginning of a recession.
Right.
Yeah, so I'm up here on my soapbox a little bit, to be honest with you, because I'm starting to get a little tired of hearing and seeing some of the headlines that go by. And the problem is a lot of people look at the headlines.
I'm gonna have to grab one of my old ivory soap boxes, those ivory soap crates, and bring it here to Studio A so that you can actually stand on that soapbox.
No, I appreciate that.
And spout it off.
Then you'll never get me to be quiet. But it's just aggravating. Number one, we as people have a responsibility to get all the facts. Okay, you got to find a news source that actually has kind of a unbiased way of delivering news. Okay, but then you get these headlines that skew it to one direction or the other, and then when you read it, I saw the numbers come out, whatever that was, Thursday or Friday.
Right.
Guess what? I'm like, okay, no big deal. Well, the news stories come out and they make it like, oh, guess what? The inflation is heating up again, right? No. I mean, technically, I guess it went up a degree if you want to be technical about it, but it's not some big deal. And the month before was better than expected. The next month might be better than expected. Who knows? You got to look at the trends, and then you definitely got to get into the stories and actually read the story and see what it means. Because with many of these numbers, you get this month's number, but they also go back and revise the number from the prior month. Well, you got to go and look and see what happened to the number in the prior. That's why I want to.
Because then that's a real number.
Well, or
because they have the full picture. When they go back and revise it, they're saying, okay, this is the actual. It's like a second shot at your taxes. It's like, okay, revise that. Now here's the clear picture.
Yeah.
So you can't just look at, this instant. Let's see what happened last month or last quarter, depending on how what analysis you're using.
Precisely, and that's the thing with the gross domestic product, because we'll get the gross domestic product sometime in April, later in April.
Right.
3 months from now, we'll get a revision to the first quarter gross domestic product, and then 3 months from then, we'll get a final number. So
Right.
when I say 6 months down the road, I literally mean 6 months down the road before someone will tell you whether we were officially where we were officially.
Right.
Number one, and number two, technically we could be 6 months into a recession before they even tell us we're in a recession, or we can think we're in a recession, and 6 months from now they're like, guess what?
Yeah.
It wasn't really technically by definition of recession. So,
well, it becomes terminology, language, and listening. If you're hearing it or reading it, you need to look at when they say early indicators. I mean, that's a difference. Here's an early indicator, and we may be headed toward. However, they don't report it. We're headed to it, as opposed to we may be headed toward a recession.
Right.
Is different than we're headed into a recession.
yeah.
Different words. You got to look at, and it's the early indicators. Well, early indicators, like you said, 3 months from now is going to get revised, and the 3 months after that, there's going to be an actual. This is the fact. It's
This will be our final answer.
Phone a friend. Hopefully, phone a financial expert friend, which is why you're here on Taking Stock to share. And I mentioned it's funny because I said, "What are the analysts saying?" And I have sitting across from me here in Studio A an analyst. I mean, it's what you've been doing, right? And is that a wrong term for you?
No, I mean, I've been doing it for a bit. I mean, that was actually my first big boy job I was the director of research. That was my first big boy job, and it was my job to do the analysis and analyze the companies and analyze the economic numbers and all that kind of stuff and write reports and all those things like that. That was my first job. So it's and it's kind of honestly it's I still have my hundreds of spreadsheets and things like that. Which my kids get enjoyment out of. But I mean, it's still. But you know what? A whole lot of it has become a gut thing. It's there have been over 3 or 4 decades now. There have been things that happen now that I just automatically recognize. Right. I don't have to plug it into a spreadsheet to tell me where we are. Right. It's just like, okay, I know where we are.
The listeners could not see my facial expression. You saw it when you said, it becomes a gut thing, and I'm like, I got the furrowed brow and,
right.
and more intent. What do you mean? So it's good to hear though, and I knew. I mean, because I get it. You've been doing it all those years, and it's not a gut. Like, my gut tells. No, it's my experience.
Yeah.
That's the gut we're talking about. We're talking about a gut of experience that you recognize, these trends, or patterns or whatever, and say, seen this before, that's a good sign, buy this or move that or whatever it means. Mm-hmm. So when you say gut, you say my experience tells me I've seen this and here's what, not that, something could change,
sure.
And your gut's not going to be 100% accurate.
Oh, 100%. But it's just going to say that I am not always going to be right. I tell my clients that all the time. I am not always going to be right.
Well, you're playing shortstop and the ground ball's hit right at you, and you didn't see that little pebble, and all of a sudden it bounces to your left and it's into left field, a base hit.
And these days, the little pebble is people running their mouths. To be honest with
right.
you, everything I can say this is going to happen, but I've probably said to you a few times. It's like that unless somebody does something stupid.
I've not heard that.
I mean, it's there's I'm going to be kind, but I mean, it's there are we could be just moving right along, and then someone says something. And then, next thing you know, we're getting off the highway and heading down a different road. So,
well, that was why, that's why I threw into the mix today a little bit about, like, what are the analysts saying? Yeah. What are you hearing? And for Jarvis Global Investment clients, they can hear that, they can call you and get freaked out or something, but at the end of the day, their analyst who's looking at things and making decisions on whatever those investments are for your clients, that's you, and they don't need to worry about what the other guy is saying, or because you're watching the numbers, you're watching the trends.
Not only do I'm not worried about what the other guy's saying. I don't want to hear what the other guy's saying. And that might sound counterintuitive, maybe, but I don't want someone else muddying up my work. Okay.
Right.
Yeah. So, but here's the problem. Here's the crux of the dilemma for me is, if you keep reacting to the way things are being presented to you, some of this can become a self-fulfilling prophecy. And especially when you're talking about the consumer. So we got a good consumer spending number last week, okay?
Right.
Better than expected, okay? And that in spite of, again, the consumer is 70% of gross domestic product, but, that's still a good number. So now, are people concerned? Is consumer sentiment down? Is consumer confidence down? Yes. Is that translating into consumer spending? Not up to this point. It's not. Guess what? Consumer spending was up like 0.8%. Okay, so guess what? People are still spending money now. You might want to make an argument of whose money are they spending, but it's until. And I've said it multiple times, until I start to see us starting to lose the consumer, I generally don't get too concerned.
Well, I was going to say, whose money are they spending? Well, the consumer is spending his own money because we don't get to collect taxes from somebody else, so we can spend their money.
Yeah, but you can wear out a credit card.
Well, again, and then how many times we're coming up. In just a few short episodes from now, we will have reached 2 years of taking stock. Mm-hmm. Then how many times in those 2 years have you heard me throw that question at you? But Art, the consumer spending, how much of that is setting their credit cards on fire because they're using them so much, and they it hasn't. We haven't seen that credit crash that we saw, which was a big part of the mortgage fall in 2008, right?
Correct.
So we haven't seen that. There's no indicators saying that people are just overspending on their credit card.
No, not. I mean, credit card levels have gone up from where they were, let's say, in 2020 to 2022. No doubt about that, because they found all that money that we pumped, all that COVID money that we pumped into the economy. It took 3 or 4 years, but we burned through it, right?
Right.
And although there are still a lot of companies out there still trying to get some of that COVID money, for smaller businesses where it was a piece of cake to get taken care of, but some of these bigger businesses, they're still trying to get that money. So, but yeah, I mean, you started, but credit cards haven't shot through the roof,
Right.
So. But yeah, it's
there's nobody sounding the alarm right now on credit card spending.
I won't say nobody. But
you know what? And I was going to say I should correct myself because, and I would, anybody that asks me about it, I would tell them, don't abuse your credit card. Use it, pay it, and then use it. Don't build up. I'm sure you as an advisor and an analyst in the world of economics is going to tell a client or somebody that asks for that kind of advice, you can say, credit cards are good to have, but you got to pay it.
Yeah.
Don't let credit card debt
Right.
be part of your world, part of your personal economics. Credit, that's like the federal budget debt, right? The federal budget deficit. You don't want a federal budget deficit in your own house.
No. Well, yeah, right. It's funny how so many places you're not even allowed to have one, right?
Right.
But and it's funny how many times I've had this conversation within the last few weeks is, someone has a baby, let's say. Well, the first thing they want to do is they want to run and go set up an education account for their kid. Well, that's fantastic, but the problem is you've got $20,000 worth of credit card debt over here, and that's great that you want to put away $100 a month or whatever for your kid for college, and we're going to make 8, 9, or 10% a year on that money. But the problem is you've got another $100 over here on this side that's costing you 25%.
I was going to say 19, 20 plus.
Look, I don't know you can't compete, okay? Now, if you got a car payment at 3% or a mortgage at 3% and you're making 8% on your investments, guess what? That's good debt, right? I mean, there's good debt and there's bad debt.
Right.
So you gotta balance out, but yeah, I mean, one of the first questions I ask people, how are you doing from a debt standpoint, A lot of times we're doing really good. Okay, great. We check that off. We can move on to the next topic. Or, we've got a little bit. Well, let's work on getting rid of the little bit first before we really start worrying about pumping money into an investment portfolio.
Right.
Because I can't, even if I make 10%, I can't compete with 25%. I'll say it again. So,
yeah.
So credit cards are an interesting thing. But I still, I'll say it one more time. I don't want this. I don't want a certain news story to be beat into people that we're in a whole lot of trouble, and then the consumer actually ends up backing down because they think we're in trouble or heading into trouble. It never materializes, or it ends up materializing because it became a self-fulfilling prophecy, right?
Right.
So, and I'll be honest, and maybe I'm running around with a different crowd, but I know a couple of people that have lost their positions and things like that here in the last few months, but it had nothing to do with the economy. I can't say that someone has come up to me and said that they've lost their position because this company's cutting back or anything like that. Okay. Now, I know there's a whole lot going on in the government sector right now, and we've got an employment report coming out this Friday. I'm going to watch that with great interest, right? But it wasn't everything that happened in February wasn't going to show up at the beginning of March. If we really have some things going on, it should at least start to show up, in this number that's coming out, in the March number that's coming out at the beginning of April. So we'll keep an eye on that. So, all right.
Speaking of numbers coming out, when we closed Taking Stock episode 46 2 weeks ago, we knew that before we recorded today for episode number 47 that the Feds were going to meet. Mm-hmm. And we didn't really, you didn't, certainly I didn't, but you didn't, nor did I make any kind of forecast, but we thought, well, let's have an interest, we might talk about it. But the Feds really did nothing last week, yes?
No, if they didn't do anything last week, they shouldn't do anything at the next meeting. They probably shouldn't do anything at the next meeting. I'll say it again. Again, I'm talking about from my little, spot in Loveland, Ohio. But I mean, it's I don't understand why we lowered interest rates 0.75% back in the end of 2024. Right. I still can't figure out why we did that. Okay, and then here we are sitting there having a conversation about inflation's heating up. Well, what are you doing lowering interest rates then? So yeah, I mean, it would have been a stunner if they had done anything last week. I still say the next one coming up, I would be stunned if they do anything unless something just changes dramatically. But again, I don't see that on the horizon. So I think the Fed needs to be in a sit back and watch kind of mode, especially considering all the things that are going on in the world right now. Yeah. But like I said, there's 10 pots being stirred right now, and I think even for the Fed, it's hard for them to kind of determine, what exactly is the impact of all these different variables coming in at once.
Yeah. Well, all the different variables, the one that keeps coming to the fore right now for everybody, and however it's being reported, however it's being talked about in the media, however other analysts are viewing it, it's still that one word right now is tariffs. Mm-hmm. And what are they going to mean ultimately? The thing that was shocking to me, Art, in the last 2 weeks, because we've stuck with, you and I, myself included, you're the expert, but myself included, the tariffs and the discussion of tariffs from the Trump administration, from Trump himself, get them to the table.
Yeah.
However, the shocking thing the last 2 weeks, I'm sure you heard it. I see that glint in your eye right now as I'm saying this. He said, it's not about getting it. These are permanent. I'm not messing around.
Yeah.
So just with that in mind, I wish people could see it right now.
You would turn this into a TV show?
Yeah, one of these days, right? Little video. But the bottom line is, they can get a sense when you respond. what do you think of that comment? And does it change your thought processes about what is to come?
Not at all.
Okay. Well, that's the answer.
Again, there are things that happen. If you're the Federal Reserve, or you're a politician, or you're whatever, a mayor of a city, there are ways to get things accomplished, and you can accomplish things. Let's just say from a Fed, you can accomplish things by moving interest rates up and down. Well, guess what? You can also change things, move interest rates up and down, change things just by jawboning, right? Just by the words that come out of your mouth and how those words are portrayed in media and things like that, and how people take that in, right? So you can not do anything except for run your mouth and accomplish maybe what you are trying to accomplish, right? So that's my first thing. So, one, are they there forever? I sincerely doubt it. Okay? But, no one asked me once again. But but here's the other part of the equation, and I'm going to lose it here because I've been talking too much. Shoot. Well, I apologize. I lost the second thought because it must have been
the other part of the equation
thought.
of whether the tariffs are permanent, which you said you doubt. Mm-hmm. So what is the other half of that? What if they are?
Oh, so yeah, thank you. Yeah.
I know where I was listening. I heard where you were going,
Chuck. But so the other part of the equation is it's okay. So these are permanent. Well, guess what? Let's say the tariffs from Canada from 20 years ago. Well, guess what? They've been going on for 20 years. Okay, so if we end up making adjustments somehow, whatever those adjustments end up being, who's not to say they're not going to last for a couple decades, right? But you're talking about the United States and dozens of different countries that are being impacted by these things, right? So, for some countries that may be very true. For other countries, it might just be a negotiating technique or something like that. So, but again, I'm not a master negotiator. There's people out there that.
I am.
Are you? Well,
sure.
Good. We'll send you in, and not me. So, but
they're not asking for me. It's the same as you.
Not yet. We're still trying to get into the Oval Office, so we'll see how that works. But So yeah, I guess my response to that is it's a big fat we'll see. But from my standpoint, I think there is a whole. What are other countries? How are other countries responding? Other countries are responding at all. Well, we're prepared for that, and the United States isn't going to like it, right?
Yeah.
Well, what's that mean? Well, it means they're not going to like it, but they're not going to give any details, right?
Right.
Okay, well, fine. So there's this little ticky-tacky thing going on right now, but that's what's going on.
Well, the tomato
right?
I'm going to throw is way bigger than the tomato you're going to throw.
Yeah, well, yeah, right?
I'm just saying.
But hopefully that's what's going on the outside of the room. Hopefully there's something completely different going on the inside of the room, right?
Well, so. I thought the headline out of what you just said is, that's a big fat we'll see.
Well, I think I could say that to most things, actually.
Right?
But that's I just don't. I think our current administration has a very strong way that they negotiate things. And I think that's just another part of it right there. So
that brings us to the 30-minute mark.
Mm-hmm. How about that?
How about that?
We actually stretched it out to a 30-minute show.
I don't know how you did it. When you started with, I think we can call this in 30 seconds. I really didn't think we should.
No. We want listeners to get their money's worth.
Well, the thing is, somebody who's listening might say, "Wait a minute, this is the one I heard 2 weeks ago,"
right?
Because we were going to fill in with the blank. But anything you want to say about what's ahead 2 weeks from now?
I think we're going to have the same thing for a couple more weeks. I think we'll probably have it for another couple months, to be honest with you.
Yeah. Well, you were talking the employment reports that are coming out.
Yeah.
So
we'll see.
That's something we'll see where that takes us.
Yeah, and honestly, I haven't seen the early numbers
yet.
So Wednesday, Thursday, Friday, we'll start to see some estimates and things. But and again, this will be the first time maybe I said this, but it's not a thing until it's a thing. If that makes sense, right? I mean, we can talk about it. I can keep telling you it's a thing.
Okay, Yogi.
Right? Yeah, there you go. You're welcome. Yeah, there you go. Words of wisdom. But I mean, we can sit there. I can sit here and keep telling you it's a thing. You know,
Okay.
and I've had people they'll tell me something over and over and over again and expect it all of a sudden to become true. Just because you keep repeating it doesn't mean it's right.
That's the thing.
Yeah.
That's the thing. People will tell you over and over.
Mm-hmm.
I get it.
But then I love when the facts get in the way of rumor. So we'll.
Well, in 2 weeks we're going to get back to some facts in taking stock. But for today, that concludes episode number 47. Art Jarvis, thank you so much for joining us again, sharing your insights. What's a thing and what's not a thing.
There you go. My pleasure. Thank you, Chuck.
You're welcome. Have a great week, and thanks everybody for listening. That is it for Taking Stock, episode number 47. Thanks for joining us for this edition of Taking Stock with Art Jarvis. Join us again in 2 weeks for our next edition. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Jarvis Global Investments, LLC is a registered investment advisory firm. The advisor is not attempting to furnish personalized investment advice or services during this production. Individuals should fully investigate the appropriateness of any investment before investing. Past performance is no guarantee of future results. Investments may lose value.